The notion that security prices should fully reflect all available information is called efficient market hypothesis. So why is that? Why stock price should reflect all available information? Let's consider this example. Let's say Netflix is trading for $420 today. If it's easy to predict that the price of Netflix should increase to 450 tomorrow, every investor would want to buy Netflix today. And on the other side, all the current shareholders of Netflix will not be willing to sell Netflix at 420 because they can also predict that its price would increase to 450. So there should be an immediate jump in the price of Netflix from 420 to 450. It's also common to distinguish between three form of market efficiency. Eugene Fama first come with this framework based on three form of market efficiency: the weak form, the semi-strong form, and the strong form efficiency. Okay, so these different form of efficiency tell us to what degree the informations are incorporated in stock prices. So, for example, in the weak form efficiency, all information related to history of stock prices is already reflected on the stock prices. So history of stock prices is what was the stock price yesterday, day before yesterday, and a month before yesterday, and so forth, and all the volume at which the stock was traded at. Because it's so easy to get access to such a data at a very minimum cost, we should expect that all investors have that information. So having that information and analyzing it should not give us a higher return than the average return on the market. Okay, so in other words, if the market is weak form efficient, you cannot earn higher returns by doing trend analysis or technical analysis. Similarly, in the semi-strong form, we argue that all public information should be already incorporated into stock prices. The public informations, or the example of public information is financial statements or any financial reports that is publicly available to the investors, and other news related to the management or the productions of a company. So in the semi-strong form efficient market, we cannot earn abnormal returns or higher returns than market by simply doing the fundamental analysis. In the fundamental analysis, we are forecasting the cash flows based on what is in currently available data and financial statements. And if the market is semi-strong form, because this data is usually available to the investors at a minimum cost, we cannot earn higher return than the market if the market is semi-strong form efficient. And finally, Strong form efficiency is that all information, including all public information and all private information, has already been reflected in stock prices. This is a kind of strong assumption and or extreme assumption because usually insiders, the managers of a corporation, have information that is not available to the public. So now let's see what is the reaction of stock prices to new information in an efficient market. So, first of all, new information is something that is unexpected or it's a surprise. So, if we expect some event to happen, uh, investors should have already take action to that event, and then the prices should have already been reflected that information. But the new information is something that is unexpected for investors. So let's say we want to trade uh, shares of Microsoft near its earning announcement. Uh, the analysts for Microsoft have predicted that Microsoft earnings per share would be $3 this quarter. Then, when Microsoft actually announces its earning, we would see that the earning is $4 per share. So this $1 increase in the earnings is a surprise to the market. Market had expected $3 earnings per share. So the reaction of stock prices of so the reaction of stock of Microsoft to this new information should be in the form that you see in the green line here. If the market is efficient, there should be an immediate jump in the price of Microsoft because, again, all investors want to buy Microsoft because they predict that its price should go up. On the other side, the shareholders would not want to sell their shares because they are also aware that there has been increase, an unexpected increase in the earnings of Microsoft, and now the worth of stock is higher than what they have. So they don't want to sell it at the price that is currently available. So then there would be a jump in the Microsoft price, okay? Microsoft stock price. On the other hand, in an inefficient market, there might be different reaction to the new information. One type of reaction is overreaction to good news with reversions, as you can see in the red line here. So this red dashed line first shows an overreaction to the new information, meaning that the stock price goes beyond what it really worth, and then in the following days, the stock price slowly go down, and until it reaches what it should really worth. The other case might be a delayed response to good news. So after the new information announcement, the stock price might be very slow or sluggish, and you see it here in this dotted blue line. So after the days after the announcement, the stock price is slowly going up until it reaches what it should have really been, the price for Microsoft.